In this video, we're going to be using a lease amortization table to prepare the journal entries for a sales type lease with a lessor. In this example, we have a lease for an asset that normally sells for $125,000. The lessor has calculated the lease based on an implicit interest rate of 12%. Payments will be made monthly at the beginning of each month, starting on day one of the lease. Since we have 12 payments per year and 12% interest rate, our periodic interest rate is 1%. We have a 3-year lease that has 36 payments. The lease payment amount has been calculated at $4,111, and it cost this manufacturer $100,000 to produce this product. On the date of the signing of the lease agreement, we can take one of two alternate approaches. Let's begin with the accounts that will be used to prepare this first journal entry. Since this is a sales type lease, we're going to be treating it as if it is a sale on credit. So we are going to be debiting accounts receivable, since this is a sales type lease, we're also going to be recognizing the cost of goods sold. We are also going to be recognizing revenue from the sale, and we'll be recognizing the reduction in inventory that occurred when this item moved from our finished goods inventory out of the warehouse into our customer. The differences in the two methods, alternate method number one and alternate method number two, deals with how we're going to value the accounts receivable. Traditionally, the debit to accounts receivable was based on the total amount of payments that would be made over the life of the lease. In this case, that would be the total of all our payments, or $147,985. Our cost of goods sold is equal to our manufacturing costs of $100,000. The revenue will be equal to our normal selling price of $125,000. And our reduction in inventory is equal to our cost of goods sold. Now, right now, our debits and credits are equal. We have $247,985 in debits and $225,000 in credits. The missing amount, the credit, will be to a liability account for unearned interest revenue. And that is going to be the total amount of interest that we're going to earn over the life of the lease, and that equals $22,985. So now our debits and credits equal each other. We have recognized an asset for the full amount of cash we're going to receive over the 3-year period, and we've also recognized a a liability for the unearned interest revenue. In the alternate method, we're going to recognize accounts receivable, cost of goods sold, revenue, and inventory. However, the accounts receivable value will be derived from the revenue that is recognized. So it will equal the normal selling price of $125,000. Our cost of goods sold remains at $100,000, and our reduction in inventory is $100,000. So under this alternate method, we do not recognize the liability account in the interest revenue, and we value the accounts receivable at the present value of the leased asset that is being accounted for as a sale. In future journal entries under alternative method number 1, the company will receive a cash payment, and that will always be the $4,111. The corresponding credit will be to accounts receivable for an equal amount. So let's look at what the entry would be now for the first, because on day 1 there is no recognition of interest revenue. Let's look what happens at the second payment on October 1st, 2012. We'll of course receive the cash, reduce the accounts receivable. However, we're going to have to prepare an adjusting journal entry at this point to recognize the interest earned from this payment. And that'll cover the 1 month period from September 1st to October 1st. So we're going to be reducing the unearned interest revenue by the amount in the amortization table, $1,200. Our credit will be to recognize interest under alternate method 2. We're still going to receive cash we'll also reduce accounts receivable, and we will recognize interest revenue. And since we never booked any unearned interest revenue, our credits will again come from the amortization table. For the accounts receivable, we'll be reducing it by the amount of principal reduction from the amortization table. And we'll be recognizing the interest expense for that period. The total of our debits and credits equal, and we have a good journal. And we will continue that through the life of the lease. And in both methods, means GAAP requirements. Alternate method number 2 is preferred by those who feel that fair value is critical, since it is more conservative in the evaluation of the asset account. For others, they feel that the offsetting liability maintains net assets at the correct amount. In the new FASB standard that is in exposure draft at this time, alternate method number 2 is the one that is cited that should be used. Again, that's in the proposal. It has not been adopted, but more than likely